Well, certainly over the last 18 months, prices of things like fuel, housing, commodities have really spiked a lot higher, and has consumers and governments and planners concerned, and they ought to be concerned. One has to worry about changes of expectations the longer that a higher level of prices is in place. These still look to be transitory to us. Part of it is the effect of people's growing personal income and an inability to spend that during fairly restricted periods, and especially during lockdowns. And you release them into the economy, well, they're going to spend. That comes crashing into supply chain disruptions that are also a product of COVID-19. So there's a degree of normalization that lies ahead that will alleviate some of that pressure, but it's expectations that we need to be concerned with. Longer term, structural forces, I think, will dominate. You have an aging population. You're going to have lower nominal rates of GDP growth, and that's highly correlated with lower levels of inflation. So, as the handoff from the near term to the long term happens, as you move beyond COVID-19 to 2022, 2023, and beyond, this should look after itself. So we'd look for something like 2 to 4% inflation, and everywhere in the world, with the U.S. actually at the high end of that in 2021, uh, dropping to 1 to 3%, again with the U.S. at the high end of that in 2022, and those problems tapering off further down the road.